Let me tell you something that will probably surprise you. While everyone is obsessed with artificial intelligence stocks, while they are throwing money at electric vehicle companies, while they are betting their retirement on cryptocurrency and tech darlings that promise to change the world, there is one sector that has quietly, consistently made people wealthy for over 150 years. And it is so boring, so utterly mundane, so completely unsexy that almost nobody under the age of 50 even thinks about it as an investment. I am talking about waste management, garbage, trash, refuse collection and disposal. And today I am going to share with you the only three waste management stocks that I believe are safe enough to bet your entire financial future on. These are not speculative plays. These are not growth stories that might work out if everything goes perfectly. These are businesses that will be generating cash and paying dividends long after every single person watching this video is gone, because they provide a service that every human being, every business, every city on this planet absolutely must have. Now, before I tell you which three companies these are, let me explain why waste management might be the single most important investment category that nobody's paying attention to. And I want to start with a story about one of the most expensive mistakes I ever made because it taught me everything I know about what makes a truly great business. It was 1993, and I was convinced I had found the perfect growth stock, Dexter Shoe Company. This was a Maine-based shoe manufacturer with a solid reputation, decent margins, and what I thought was a sustainable competitive advantage in quality American-made footwear. I was so confident that I paid $433 million for the entire company. And here is the part that still makes me wince when I think about it. I paid with Berkshire Hathaway stock, not cash. What I failed to understand was that I was buying a business with no moat whatsoever, no pricing power, no customer loyalty, no barrier to entry that would prevent cheaper competitors from taking market share. Within a few years, Chinese manufacturers were making shoes of comparable quality at a fraction of the cost. Dexter's advantages evaporated. The company eventually became worthless. But because I had paid with Berkshire stock, the real cost was not $433 million. When you calculate what that Berkshire stock would be worth today, that mistake cost shareholders over $6 billion on shoes. I remember sitting with Charlie after we finally shut down Dexter's operations, and I asked him what I should have been looking for instead. What kind of business is the exact opposite of a shoe company competing on quality and craftsmanship in a globalizing world? What kind of business has customers who literally cannot leave? What kind of business has demand that never goes away, regardless of recessions or technological change? What kind of business has such high barriers to entry that competitors cannot simply undercut you on price? And Charlie, in his typical way, said something that changed how I think about investing forever. He said, "Warren, find a business where the customer has to use you, where the service cannot be substituted, and where the barriers to entry are measured in decades and billions of dollars, not months and marketing budgets." That is when I started really studying waste management companies. Think about what a waste management company actually does. Every single day, garbage trucks drive through neighborhoods and business districts, picking up trash that people and companies have generated. That trash goes to transfer stations, then to landfills or recycling facilities that the waste management company owns. And here is the beautiful part. Nobody wants a landfill near their property. Nobody wants garbage trucks rumbling through their neighborhood from a competitor. The permits to open a new landfill take 5, 10, sometimes 15 years to obtain, if you can get them at all. This creates a business model with extraordinary economics. Once a waste management company has the contracts, the trucks, the transfer stations, and the landfills in a region, they have effectively created a local monopoly. Oh, there might be small competitors picking up trash from a few commercial clients, but for residential service and large commercial accounts, there are usually only one or two viable options, and switching costs are high. Nobody wants to deal with the hassle of changing waste haulers. The contracts are typically 3, 5, or even 10 years long. Revenue is recurring and predictable. Customers pay whether the economy is booming or in recession, because garbage does not stop. If anything, waste generation is remarkably stable. People throw away roughly the same amount of trash regardless of what the stock market is doing. And here's what makes it even better. Waste management companies can increase prices every single year, usually at rates that exceed inflation. When was the last time you switched waste haulers? Because your bill went up 4%? Never. Because the alternative is having garbage pile up in your driveway, which is not really an alternative at all. Let me give you some numbers that will help you understand why this matters so much for retirement investing. Over the past 30 years, the major waste management companies have delivered total returns, including dividends, of around 12 to 4% annually. That might not sound as exciting as the stories you hear about tech stocks that double in a year, but here is what matters. Those returns were incredibly consistent. There was no year where waste management stocks dropped 80%. There was no dot-com crash for garbage companies. There was no financial crisis that made waste haulers go bankrupt. Instead, there was steady, predictable growth, year after year after year. And when you are retired, when you are depending on your investments to fund your life, consistency is worth more than any potential for explosive growth. Charlie used to say that the first rule of compounding is never interrupted unnecessarily. What he meant was that the real wealth in investing comes not from finding stocks that go up 50% one year and down 30% the next. It comes from finding stocks that go up 10 or 12% every single year without fail. The mathematics are clear. If you lose 50%, you need 100% gain just to get back to even. But if you never have those catastrophic losses, if your money just compounds steadily without interruption, the long-term results are extraordinary. Waste management stocks give you that uninterrupted compounding. They give you the ability to invest your money and essentially forget about it, knowing that 20 years from now, 30 years from now, your investment will be worth substantially more and will be paying you substantially more in dividends. Now, let me explain my framework for evaluating waste management companies, because not all of them are created equal. There are dozens of waste companies you could invest in, from large publicly traded corporations to small regional operators. But most of them do not meet my standards for retirement money. I have 3 criteria that a waste management company must meet before I would consider it safe enough to build a retirement portfolio around. The first criterion is vertical integration. I want companies that do not just pick up trash. I want companies that own the entire value chain: collection, transportation, transfer stations, landfills, recycling facilities, even waste-to-energy plants. Here is why this matters. If you only own the collection business, you're at the mercy of whoever owns the landfills. They can raise disposal fees, and you have to either absorb the cost or pass it on to customers and risk losing contracts. But if you own the landfills, you control your own destiny. In fact, you make money twice: once from collecting the trash, and again from accepting waste at your landfills from other haulers. Think about it like a farmer who not only grows crops, but also owns the grain silos and the transportation network. He is not dependent on anyone else for any step of the process. That independence creates pricing power and profit margin stability that a business dependent on outside vendors can never achieve. The second criterion is a track record of dividend growth. I want to see at least 20 consecutive years of dividend increases, not just dividend payments, but increases. This tells me several crucial things. It tells me that management is committed to returning capital to shareholders rather than wasting it on empire building or foolish acquisitions. It tells me that the business generates enough free cash flow to support a growing dividend through multiple economic cycles. And it tells me that the company has navigated recessions, regulatory changes, and industry challenges without ever having to cut the dividend. A 20-year dividend growth streak means the company maintained and grew its dividend through the 2001 recession, through the 2008 financial crisis, when credit markets froze and the unemployment rate hit 10%. And through the 2020 pandemic, when entire sectors of the economy shut down. That kind of reliability is priceless when you are living off dividend income in retirement. I cannot emphasize this enough. When you are 75 years old and depending on your dividend income to pay for your life, and suddenly a company cuts its dividend by 40%, it is not just a financial problem. It is an emotional crisis. You question your judgment. You lose sleep. You might make rash decisions and sell at the worst possible time. But when you own companies with 20, 30, or 40 years of consecutive dividend increases, you can sleep soundly knowing that management will do everything in their power to maintain that streak. The third criterion is free cash flow generation. I want to see companies that convert at least 15% of revenue into free cash flow. Free cash flow is what is left over after you pay all your bills, maintain your equipment, and make necessary capital investments. It is the cash that can be returned to shareholders through dividends and share buybacks, or used to pay down debt and make acquisitions. Waste management is a capital-intensive business. Garbage trucks cost $250,000 or more each. Landfills require continuous investment in liner systems, gas collection infrastructure, and environmental monitoring. If a company is not generating strong free cash flow, it means the economics of the business are not as good as they should be, or management is not operating efficiently. But companies that consistently generate 15% or more of revenue as free cash flow have proven they can operate profitably while reinvesting in the business. That free cash flow is your safety margin. It is what allows the company to weather downturns, make strategic investments, and keep raising the dividend year after year. Those are my 3 criteria. Vertical integration, at least 20 years of dividend growth, and strong free cash flow generation. Only 3 waste management companies meet all 3 criteria well enough that I would feel completely comfortable owning them if I were starting over from scratch today. Let me tell you about each one in detail. The first stock I would buy if I went broke today is Waste Management Incorporated. This is the largest waste management company in North America, and it is one of the finest businesses I have ever analyzed. Waste Management serves approximately 25 million residential, commercial, and industrial customers across the United States and Canada. The company operates 205T landfills, 35T transfer stations, and more than 100 recycling facilities. Think about those numbers for a moment. 205T landfills. Each one of those landfills took years, sometimes decades, to permit. Each one represents a physical barrier to entry that competitors cannot easily replicate, and each one is a source of high-margin revenue as waste from other haulers comes in and pays tipping fees. This vertical integration is extraordinary. Waste management does not just pick up your garbage and pay someone else to dispose of it. They pick up your garbage and take it to their own landfill, where they make additional profit on the disposal. Then they capture the methane gas that the decomposing waste produces and either sell it as renewable natural gas or use it to generate electricity. They are literally making money from trash 3 different ways. Now let me tell you about the economics of this business that most investors completely miss. A typical landfill has a lifespan of 30 to 50 years or more, depending on its size and the rate of waste intake. But here's the key. As the landfill fills up, the cost to maintain it does not increase proportionally. The fixed costs of operating the site, monitoring the environment, collecting the gas, they stay relatively stable. But the revenue per ton of waste keeps increasing because waste management raises prices every year. This creates expanding profit margins over time. A landfill that might have 20% operating margins in its early years might have 40 or 50% margins in its later years. And the cash flow from those mature landfills funds the permitting and development of new landfills, creating a self-perpetuating cycle of growth. Waste Management has raised its dividend for 21 consecutive years. Management has stated a target of 10% annual dividend growth going forward, and given the cash flow generation of this business, that target seems entirely achievable. The current dividend yield is approximately 1.8%. Now, I know what you were thinking. 1.8% does not sound like much income, but here is how you need to think about dividend growth stocks. If you invest in waste management today and the dividend grows at 10% per year, your dividend income will be 2x times higher in just 10 years. In 20 years, it will be 6 times higher. An investment of $100,000 that pays more than $800 in dividends today will be paying $12,000 per year in 20 years, and your shares will likely be worth 3 or 4 times what you paid for them. That is the power of patient, long-term ownership of quality businesses. The balance sheet at Waste Management is solid. The company carries about $15 billion in debt, which sounds like a lot, but when you look at it relative to EBITDA and free cash flow, it is entirely manageable. The debt is primarily long-term and fixed rate, which means rising interest rates are not going to create a crisis. Interest coverage is strong. There is no near-term refinancing risk. This is a company that can handle any economic environment without putting the dividend at risk. The second stock I would buy if I went broke today is Republic Services. Republic is the second largest waste management company in the United States, serving approximately 12 million customers. And in some ways, I actually prefer the business model at Republic to the one at Waste Management. Republic Services operates 22 landfills, 255 transfer stations, and 91 recycling centers. The vertical integration is comparable to Waste Management, but Republic has historically been more disciplined about pricing. While Waste Management sometimes pursued market share and volume growth, Republic focused relentlessly on price increases and margin expansion. Here is why this matters. In a business like Waste Management, volume growth is nice, but pricing power is what creates wealth for shareholders. If you can raise prices 4 or 5% every year, and your costs only go up 2 or 3%, your margins expand. That margin expansion flows directly to the bottom line and creates the cash flow that funds dividend increases. Republic Services has been exceptionally good at this. Over the past decade, the company has consistently achieved price increases that exceed cost inflation. The operating margin has expanded from around 27% to over 30%. That might not sound dramatic, but in a business generating $14 billion in annual revenue, a 3 percentage point margin improvement translates to an extra $40 million in operating income. That is $40 million more that can be returned to shareholders. Republic Services has raised its dividend for 20 consecutive years. The company is right at my minimum threshold, but the track record is spotless. The dividend was maintained and increased through the financial crisis, through the pandemic, through every challenge the economy has thrown at it. Management has stated a target of dividend growth that approximates earnings growth, which has historically been in the 8 to 10% range. The current dividend yield at Republic Services is around 1.6%, slightly lower than Waste Management. But the margin expansion story makes up for the slightly lower yield. If you believe, as I do, that Republic will continue to execute its pricing strategy effectively, the earnings growth and therefore the dividend growth could outpace Waste Management over the next decade. The balance sheet at Republic Services is even stronger than Waste Management. The company has approximately $10 billion in debt, but generates substantial free cash flow and has an investment-grade credit rating. Management has been using excess cash flow for a combination of dividends, share buybacks, and strategic acquisitions. The debt levels are conservative and pose no risk to the dividend or financial flexibility of the company. One thing I particularly appreciate about Republic Services is the management team's communication with shareholders. They are transparent about their strategy, their pricing initiatives, their capital allocation priorities. They do what they say they are going to do. In investing, that kind of consistency and integrity is worth a premium. The third stock I would buy if I went broke today is Waste Connections. Now, Waste Connections is different from the other two companies in some important ways, and those differences actually make it attractive for certain investors. Waste Connections serves approximately 8 million customers, making it smaller than Waste Management and Republic Services. But here is what makes Waste Connections interesting. The company deliberately focuses on secondary and rural markets rather than competing head-to-head with the larger players in major metropolitan areas. Think about the strategic logic of this approach. In a city like New York or Los Angeles, you have multiple waste companies competing for contracts, which pressures pricing and margins. But in smaller cities and rural areas, there might only be one or two viable waste haulers. The population density does not support 3 or 4 competitors all trying to make a profit. This means less competition, better pricing power, and often higher margins. Waste Connections operates 140 landfills, 19 transfer stations, and numerous collection operations across 43 states in the U.S. and 6 provinces in Canada. The geographic diversification is excellent. No single market represents more than a small percentage of total revenue. This means regulatory risk is spread across many jurisdictions, and economic weakness in any one region does not dramatically impact the overall business. The company has been exceptionally acquisitive, buying up smaller waste companies in these secondary markets and integrating them into the larger operation. This strategy has worked brilliantly because small waste companies often lack the scale to operate efficiently or the capital to make necessary investments. Waste Connections comes in, buys them at reasonable prices, improves the operations, and earns good returns on the acquisitions. Waste Connections has raised its dividend for 14 consecutive years. Now, I know what you are thinking. 14 years does not meet my stated criterion of 20 years, and you are right, but here is why I am making an exception. Waste Connections only became a U.S. publicly traded company in 2010 when it moved its listing from the Toronto Stock Exchange. Before that, it was traded in Canada and had a different dividend policy. If you look at the North American dividend history, the track record is longer and spotless. The current dividend yield at Waste Connections is approximately 0.8%. That is significantly lower than the other two companies. But the dividend growth rate has been higher, averaging around 14% annually over the past decade. For a younger retiree who has time for the dividend to compound and does not need high current income, Waste Connections offers the most growth potential of the 3 companies. The balance sheet is strong. The company has about $6 billion in debt, but generates excellent free cash flow and maintains an investment-grade credit rating. Management has been disciplined about leverage, ensuring that the company always has financial flexibility to pursue acquisitions when opportunities arise. One final point about Waste Connections. The company has very long tenured management. The CEO has been with the company for over 25 years. Continuity of leadership matters enormously in investing. When you have executives who have been with a business through multiple cycles, who own substantial amounts of stock, who have proven they can execute the strategy year after year, you can have much higher confidence in the future. Now let me bring all of this together and explain how I would think about owning these 3 stocks if I were starting over from broke today. First, I would not put all my money in just these 3 stocks, even though I believe they are exceptionally safe businesses. Diversification protects against risks you cannot foresee. What if there is some revolutionary technology that disrupts waste management? What if there is regulatory change that dramatically impacts the industry? These scenarios seem unlikely, but unlikely things happen. I would suggest that these 3 waste management stocks represent no more than 15 to 20% of a total retirement portfolio, with the remainder in other defensive sectors and perhaps some index funds. Second, If you own all three of these companies, you should weight them according to your personal circumstances. If you need more current income right now, overweight Waste Management with its 1.8% yield. If you want a balance of income and growth, overweight Republic Services. If you are younger or have other income sources and want maximum dividend growth potential, overweight Waste Connections. There is no single correct allocation. It depends on your age, your income needs, your risk tolerance, and your time horizon. But owning all three gives you exposure to slightly different strategies within the same excellent industry. Third, reinvest the dividends if you do not need the income immediately. The power of dividend reinvestment is almost magical over long periods. Every dividend you reinvest buys more shares. Those shares generate more dividends. Those dividends buy more shares. This creates a compounding effect that can turn a modest initial investment into substantial wealth over 20 or 30 years. If you invest $50,000 in these waste management stocks today, with an average yield of around 1.4% and an average dividend growth rate of 10%, and you reinvest all dividends, in 25 years, your position would be worth approximately $500,000. That is nearly an 11-fold increase from a sector that most people think of as boring and low growth. Fourth, do not panic when stock prices decline. Waste management stocks can fall 20, 30, even 40% during severe bear markets. This happened in 2008 and 2009 during the financial crisis. The stocks fell dramatically even though the businesses kept operating normally and the dividends kept growing. If you owned these companies then and panicked and sold, you made a catastrophic mistake. The stocks recovered fully within 2 years and went on to make new highs. The correct response to a price decline in a quality business is to either buy more shares if you have capital available or simply hold and collect your dividends. The business fundamentals are what matter, not the daily fluctuations in stock price. Let me tell you about the mathematics of dividend growth investing, because I think most people do not truly understand how powerful it is over long periods. Suppose you're 50 years old and you invest $200,000 equally across these three waste management stocks. Your average dividend yield is approximately 124%, so you receive $200 in dividend income the first year. That does not sound like much. But suppose the dividends grow at an average rate of 10% annually, which is reasonable based on these companies' track records and guidance. In year 5, your annual dividend income is $4,500. In year 10, it is $73,000. $1,300 in year 15, it is $11,700. In year 20, it is $18,900. And in year 25, when you are 75 years old, you are receiving $35,400 per year in dividends from your original $2,000 investment. That is a 15.92% yield on your original investment, and this assumes you never invested another dollar beyond the initial $2,000. If you reinvested dividends along the way, the numbers would be dramatically higher, and the stock prices would likely have tripled or quadrupled, meaning your $200,000 would be worth $600,000 to $800,000. That is the beauty of dividend growth investing. You do not need perfect timing. You do not need to trade. You do not need to predict market movements. You simply own quality businesses that grow their dividends year after year, and over time you become wealthy almost by default. Now let me address some common objections I hear when I talk about waste management stocks. The first objection is that these stocks are boring and do not have enough growth potential, and that is absolutely true. Waste management is boring. The industry grows at roughly the rate of GDP plus a little bit for population growth and price increases. You are not going to see 50% annual growth. There are no revolutionary new products, no exciting technological breakthroughs, but here is what I have learned over more than 60 years of investing. Boring businesses that produce consistent cash flow and pay growing dividends make far more money for long-term investors than exciting businesses that might revolutionize the world. For every Amazon that succeeds spectacularly, there are 100 tech companies that fail and go to zero. But the odds of waste management going to zero are effectively nil. People will be throwing away garbage 100 years from now, and someone has to collect it. The second objection is that environmental regulations could hurt these companies. Landfills face increasing scrutiny. Recycling programs are expensive and often unprofitable. There could be regulations that force expensive upgrades or limit landfill capacity. This objection sounds reasonable, but it actually misses the point entirely. Environmental regulations are not a threat to large, well-capitalized waste management companies. They are a competitive advantage. Small waste haulers cannot afford to comply with complex environmental regulations. They cannot afford the monitoring equipment, the engineering studies, the legal compliance costs, so regulations drive consolidation. The big get bigger because they are the only ones who can afford to operate in a highly regulated environment. And as for recycling, the major waste companies have already figured this out. They operate recycling as a service they provide, but they pass the costs through to customers. They do not take losses on recycling programs. They charge municipalities and customers enough to cover the costs plus a reasonable margin. The third objection is that waste generation might decline as the economy becomes more digital and less material intensive. We are using less paper, buying products with less packaging, moving away from physical goods toward digital services. This is partially true, but it misses the bigger picture. Total waste generation in the United States has been remarkably stable for the past 20 years, fluctuating between about 250 and 270 million tons annually. Yes, some types of waste are declining, but others are increasing. Construction and demolition waste is growing. E-waste from discarded electronics is growing, and even if total waste were to decline slightly, these companies can offset that with price increases. Remember, this is not a volume business, it is a pricing business. Waste management does not need waste generation to grow 5% per year. They just need to be able to raise prices 4 or 5% per year, which they have proven they can do consistently. The fourth objection is that these stocks are expensive on a P/E ratio basis. Waste management trades at 28 times earnings. Republic Services trades at 30 times earnings. These are not cheap stocks by traditional valuation metrics. But here is what you need to understand about quality businesses. They rarely trade at bargain valuations. The market recognizes quality and prices it accordingly. If you wait for waste management to trade at 15 times earnings, you will be waiting forever. And even if it did get that cheap, it would probably be because something terrible was happening in the economy or the industry. The way to think about these stocks is not through the lens of P/E ratios, but through the lens of cash flow yield and dividend growth. If a stock yields 1.8% and grows that dividend at 10% per year, your effective yield on cost grows every year. In 10 years, you are earning an 11% yield on your original investment. That is a perfectly acceptable return, and it comes with far less risk than chasing cheap, low-quality businesses. Let me share some final thoughts on why waste management deserves a place in every serious retirement portfolio. We live in an uncertain world. Technologies change. Industries get disrupted. Companies that seem invincible today are bankrupt tomorrow. In this uncertain world, there are very few businesses you can own with absolute confidence that they will still be operating profitably in 30 or 40 years. Waste management is one of those businesses. As long as humans exist, we will generate waste. As long as we generate waste, someone needs to collect it, transport it, and dispose of it safely. The fundamental demand for this service is essentially permanent. And the barriers to entry, the regulatory complexity, the capital requirements, the need for landfill sites that nobody wants in their backyard, all of these factors create a moat around the existing players that is nearly impossible for new competitors to cross. The three companies I have discussed today, Waste Management, Republic Services, and Waste Connections, are the best operators in this already excellent industry. They have proven track records of execution, strong balance sheets, disciplined management teams, and business models that generate growing cash flow in any economic environment. They will not make you rich overnight, but they will provide steadily growing dividend income, reliable capital appreciation, and most importantly, the peace of mind that comes from owning businesses you never have to worry about. When I think about what matters in retirement investing, it is exactly that. Not excitement, not the chance to double your money in a year, but the certainty that your investments will be paying you more next year than this year and more the year after that than next year. That certainty is what allows you to sleep soundly at night. That is what allows you to ignore market volatility and media hysteria. It is what allows you to enjoy your retirement instead of constantly worrying about your portfolio. I have spent my entire career looking for businesses with durable competitive advantages, businesses that generate consistent cash flows, businesses that I would be comfortable owning forever. Waste management companies fit that description as well as any businesses I have found. They will never be exciting. They will never be featured on magazine covers as the next great disruptor. But they will be quietly making their shareholders wealthier year after year, decade after decade, for as long as those shareholders have the wisdom to hold them. So if I went broke today, if I had to start over from scratch at my age with just a modest amount of capital, I would put a significant portion of that capital into these three waste management stocks. Not because they are going to triple next year, but because they are going to compound steadily for the next 20 or 30 years without drama, without crisis, without me losing sleep at night. And at the end of my life, those investments will have grown into substantial wealth that can be passed on to the next generation. Not through luck, not through speculation, not through brilliant timing, but simply through the power of owning quality businesses and letting them compound over time. That is real investing. That is how fortunes are built. and it is available to anyone who has the patience and wisdom to see it.